How have you seen estate planning and premium finance work well together? And where have you seen it where it's not a good fit?
Well, we'll take that one first. Where it's not a good fit, the most common scenario is the client wasn't qualified to be in the structure to begin with, right?
Yeah.
Or they were oversold too much insurance. I mean, we see that all the time as well. But the where it's really used properly, it's a great tool, as I'd mentioned earlier, to retain your own capital. When we're in higher interest rates, there's never been a time. I was just talking to one of our clients who, the guy's probably worth 800 million, and the last time he was this active in acquisitions was during the financial crisis. So, if you have dry powder and you've retained your own capital, now's a great time to go out and be in the acquiring mode because some of your competitors may not be in such a good situation or markets available because they're not growing like you are. So once again, retaining your own capital, using the bank's money to cover your liability, but allowing you to retain your own capital for other uses is key. So for estate planning, I think, I was thinking of a case we did earlier this year where we had a grandfather, family owns very successful business, and the patriarch and matriarch of the family wanted to really take care of their grandchildren's legacy. They had 10 grandchildren, 3 kids in their 40s. So basically, we did some intergenerational planning there using premium financing, where the grandparents each seeded a policy on the 3 children. They put about 2 million each in each policy. We then financed the premiums from that point forward. And we took $6 million, and at the life expectancy of G2, those policies will be worth about 400 million, which will be for the benefit of the 10 grandchildren. So it's a great way to use that leverage of financed insurance to go ahead and then, push that wealth forward in a much better fashion.